Hello friends, welcome to my 10 cent. Today, we are going to talk about compass and how it is related to markets and the money you have invested in stock market. Wondering why? Have I lost my mind? No, it's very interesting. 2000 years ago, we invented a small device, compass, right? How is it relevant? Compass signifies our desire to be masters of our destiny, masters of where we are headed. And in fact, when I meet a lot of the people, when I meet, my friends, my clients, people who listen to me speak, all the time, the first question I get is, where are markets headed? Okay. And I don't blame them, because when you switch on TV and when you look at newspapers, there are so many complex formulas, there is technical analysis, this, that, it all looks very complex. Everybody is looking for some simple solution. In fact, speaking of simple solution, it reminds me of what Steve Jobs once said. When we try to solve a problem, the first solution that comes up is typically the complex one. And most people stop there. But if you keep going, if you persevere, if you continue, and you start peeling the onions layer by layer, oftentimes you will come with a very simple and elegant solution. So today, I'm going to give you that elegant solution, a compass which will help you know the direction where markets are headed. The elegant solution and the simple solution is Sensex P by E. Now, those who know about Sensex P by E, you can quickly skip maybe 10 seconds in the video. But to just give you a quick brief for those who do not know about what I'm talking about, just a quick briefer. Sensex is basically sensitive index. In simple words, it is an index which is published every day, which shows the market value of 30 largest companies in the country and listed on the Bombay Stock Exchange. Okay. In simple words, if you want to know where stock markets are headed, look at where Sensex is. Sensex is up, markets are up. Sensex is down, markets are down. Sensex is flat, it's a boring market. They're as simple as that. That is what Sensex is. And what is P by E? It's very simple. You take the Sensex value, open a newspaper, go to any website, you will get the Sensex value. As the moment when I'm shooting this video, Sensex is about 56,000. So P stands for the Sensex value. And E, the ratio we are talking about is P by E, and E stands for the profits generated by the 30 companies which constitute the Sensex. So you take the profits of the 30 companies, divide by the number of shares, we call something called as earning per share or EPS. But for this discussion, we will keep it very simple. The earning per share of these companies is roughly about 2,100 rupees. So Sensex P by E is 56,000 of Sensex divided by 2,100, which will ballpark give you a ratio of 26. Okay. We don't get into any other technicalities of EPS, P by E. That's all content for another video, another day. But for today, we are in the pursuit of that golden compass, which is going to tell us the direction of markets and which is going to tell us about the storm before it comes, right? That simple solution, Sensex P by E. So P is Sensex value and E is the earnings or the profits generated by the companies in Sensex. You don't need to worry about how will I calculate it. Just log on to BSE website. You can find the daily Sensex P by E ratio straight off there. It's very simple. As we speak, it's about 26. So now that we've understood what Sensex P by E is, we go back to the question. How is Sensex P by E a compass to know the direction of markets? For that we need a bit of history. Okay. If you look back, we can find Sensex PE ratio all the way back to 1999 or thereabout, and perhaps a little earlier, but we will stick to 99-2000. Now, if you look at 99-2000 onwards, and you take all the Sensex P by E month and month, year on year, and plot a chart out of it. I'll show you the chart shortly. It will come up on your screen. That is a very interesting pattern. You can divide Sensex into three zones, the PE ratio into three zones: a red zone, a yellow zone, and a green zone. Red is the overheated or the danger zone. As an investor, when you put your money in the markets, if Sensex PE is in the Sensex P by E is in the red zone, it means the market is slightly overvalued. Chances are that you will lose your money, especially from a 12 to 24 month horizon. Why do I say that? Let's take three scenarios. Let's go back to 2000-2001. So some of my young viewers may have been in school and will not recollect it, but some of the older people who've been around will remember the dot-com crisis when every dot-com company looked the solution to all the problems of mankind. Yeah, remember that time? 2000-2001. Sensex was at the top. Global markets were at the top. Around June 2000, if my memory is right. Sensex PE touched almost 29, and Sensex was roughly about 4,700 or thereabout levels. What happened after that? Fast forward 2001, 1 year exactly, June 2001, Sensex was at 3,500 levels, 3,500 or thereabout. As an investor who had invested in 4,700 would have lost 35% of his wealth in the next 12 months from there on. Yes, eventually you would have made money, but the next time you have recovered your principal would have been if you stayed investor in 2005 or 6. 4 to 5 years you would not have recovered your principal, what you invested at 4,700 in June of 2000. Fast forward, another episode via 2007-8, Subprime Crisis, before the whole world came crumbling down. December 2000, Sensex was roughly at about 20,000 and the Sensex PE was 27. Market crashed. Exactly 1 year later, December 2001, Sensex was at around 9,600 or just below 10,000. 52% loss in 1 year. Right before COVID, December 19, we had Sensex north of 40,000. Sensex P by E, I think it was 27 or thereabouts. The exact number will be on the chart. March 20, COVID hits, Sensex goes below 30,000. So, there are enough instances in history that whenever Sensex stays in the red or the heated zone, as an investor, you're better off avoiding there because the chances are you are likely to lose your money. What is that heated zone? Anything with Sensex P by E over 22 is typically a dangerous zone to be in. Okay. Then we have the yellow zone, what we call it, or the medium risk zone, which is Sensex P by E between 19, 20 to 22. You can continue to invest, especially if you're on an SIP plan, if you put money every month. It's okay. Your returns may not be great, but you should do generally okay. And of course, if Sensex P by E is below 20, it's a green zone. It's a great zone to be in. Historically, if you look at it, I would imagine the chance of losing money is not that great. You are more likely to make good profits when the Sensex P by E is below 20. Whenever Sensex P by E is 20, I invest a lot of money in the markets. I've always stood to benefit from it. So in this manner, Sensex P by E works like a compass, which gives you a good sense of where the market is headed, especially from a 12 to 24 month horizon. It gives you a sense of direction. You just need to check, are you in the heated red zone or a yellow zone or a green zone, and manage your money accordingly. Now, all stock market practitioners, all analysts, all teachers, all guides, all coaches, journalists, everyone will tell you the golden mantra of investing in markets is SIP, which is Systematic Investment Plan. Do not invest your money lump sum into markets. Invest it in a staggered manner, month on month, because markets are unpredictable. Nobody knows where the market's going up or down, really. But, and if you are an SIP investor, if you are investing in SIP, then honestly, you can ignore Sensex P by E. Because even if you invest in the peak, and if the market crashes, you are going to invest even at the lower levels. So your overall cost is not going to stay here, it's going to average downwards. So you should be broadly okay. In fact, investors of SIP can pretty much ignore PE. But there are situations where you want to invest a lump sum, or you're a savvy investor, you have time to give it markets, and you've got a big bonus, and you are waiting for that great time to invest in market where over and above your SIP, you want to put a lot of money. Right after when it crashed after COVID, for example, or June 2002, for example, or 3, for example, when the Sensex PY was really below 20, market was really offering a lot of value for investors. Or you want to correct your asset allocation, or you want to make some withdrawals in the next 2 to 3 years, but you would like to let the money sit in the markets for some more time to get a little bit more profit. Whatever be the reason, there is a reason why you want to look at market and time the market beyond your SIP. If you are in that situation, then Sensex PY is a golden rule, my friends. I believe in it. I stick to it. I find it simple. I find it elegant. Honestly, beyond this, when I get into the technical charts and all that, candlesticks and this ratios and the curves, I get lost. And I can't thump the table and say they have been really useful. Sensex PY is very elegant. That's it for now. If you like the video, please press the like button. Please share it with your friends, people who you care about. And we would love if you subscribe to our channel. If you can join our website, My 10 Cent. On the website, there are a lot of free, high quality information reports for you. There is a best funds report which tells you the 45 best funds to invest. Please do take your free copy from there. Our job at My 10 Cent is to produce high quality content to educate as many people as possible. So your encouragement through a like button or a share button or a subscription or all of it gives us a lot of motivation to produce high quality content at My 10 Cent. I look forward to your support. I look forward to seeing you in the next video. Bye-bye and have a good day.